And we're back on Sì-ITALIA with economist Marco Soriano here. Hello. Thank you very much for joining us. And Europe's economies suffer from stagnating growth, separatist politics, a heavy sovereign debt, unfavourable demographics, inflexible labor markets, a migrant crisis, and religious divides. Until 2020, the price of oil will stay in the US dollars 50 to 60 range. As the shortcut to recover is an unfair mix of orderly debt, reconstructing, and mild inflation, monetary policy normalization will take longer than expected, buoying the financial markets. Are EMs in for a long period of low growth?
And over the next year, EMs have struggled, and sizable external debt capital outflows and currency depreciation really has been the issue on this. In 2015, like the third quarter of last year, we actually saw that global growth was declining from 2.6 to about 1.2. China's downturn, which in turn hit the price of commodities and specialized manufacturing equipment. We also had the recession in Brazil and Russia. Between 2009 and 2015, taking advantage of the so-called low interest rates in developed markets, EM governments, banks, and firms borrow in US dollars on an unprecedented level. The combination of sluggish growth and high external debt and its possible consequences on political volatility is taking an actual toll on investors' confidence. Mind you, between 2008 and 2014, private capital outflows from EMs have increased significantly from about 0.73 trillion to 1.05 trillion US dollars. And in 2015, for the first time since 1988, emerging markets will suffer a net capital outflow of about 540 billion was our calculation. All major currencies, with the exception of the Chinese yuan, experience or will experience a significant depreciation against the US dollars. We are already seeing these trends, as a matter of fact. To support the exchange rate, central banks have intervened in the currency markets and reduced their foreign exchange reserve by selling their DM government bonds, the DM government bond holdings. So what this actually caused? This resulted in a reduction of total foreign exchange reserve of the BRIC countries from about 5 trillion to 4.2 trillion dollars. If a market event, a US Federal Reserve, the Fed's interest rates hike, go up, a surging US dollar, a drop in commodity prices will become a conflict. And these are the causes that EM currencies to slide against the US dollar. This debt that we've had has really caused a burden in our economy. Some borrowers would become unable to service their foreign currency debts, and they would probably most likely start missing interest payments. Others could become unable to roll over principal, and corporate defaults would probably be in issue.
Would you say Europe can manage?
Europe is a very interesting situation. Across the continent, countries with different economic, social, and political structures suffer from unfavorable demographics, inflexible labor markets, and also a heavy sovereign debt. What we can say out of this is that most economies are frail, growth is stagnant, the productivity potential is declining, and unemployment is high. We know this in all the Mediterranean countries. Politics is an arduous balancing exercise. While separatist political forces are on the rise, an unresolved migrant crisis divides opinions and is putting religious divides on their agenda. So this is an issue. There are no visionary leaders. The institutional structure and policy tools needed to manage shocks are absent. Asymmetric shocks are likely, and to put the monetary union under intolerable pressure as long as it lacks a one, common fiscal policy, two, and smooth inter-country labor mobility, and number three, solid banking union. In times of savings glut, adverse demographic prospects tend to increase the supply of savings. So this lack of labor market flexibility also reduces investment demand. And as we know, low investments depress productivity. The Stability and Growth Pact, by imposing a public debt below 60% of their GDP, calls for an aggressive debt reduction via either fiscal austerity. If carried out, this would probably cause further increased excess savings, lead to a shortage of safe assets, and bring about another deflation. Instead, countries like Germany are able to borrow at negative real interest rates, have shown us that they can build infrastructure at home, and that allows other countries to suspend fiscal consolidation as long as, politically speaking, is unpalatable. But the growth-enhancing structural reforms are implemented. Obviously, this is easier said than done.
Will the price of oil stay relatively low?
The price of oil, that's a very interesting question because we love that the price of oil are low, but we are anticipating this until 2020 at least for the US to have $50 to $60 a barrel according to the International Energy Agency World Energy Outlook. In 2013, 2014, the oil market suffered fundamental supply changes as you remember, shale oil production flooded the market, particularly in the United States. And two, unprecedentedly, Saudi Arabia decided to stop playing the role of OPEC swing producer. So what this cost in the middle of 2014 is just a few months, oil prices more than half, and stabilize after a temporary overshoot. The large price drop costs, supply destruction, and some energy producers from both traditional and non-traditional sectors became unprofitable. Everybody as a consumer, obviously we reacted slowly to lower energy cost, and we demanded adjusted prices only gradually. In 2015, the OPEC, not to lose market share, renew this so-called downward pressure on prices by adding about 2 million barrels per day, or BPDs, to the total projection or production. This is about almost half of global output growth. Remember, big geopolitical losers from low oil prices include Venezuela, Russia, and Iran. This summer, in 2015, the global economy started weakening, especially in energy-intensive countries such as China and Brazil, as well as in energy production like Russia. Going forward, if the price of oil remains under $60 per barrel, producers will cut their operating costs, they will shut inefficient rigs down, and suspend new investments. This is typically the case. If production decreases, especially in the United States, over the long term, two developments are likely to take place. Number one, low oil prices will put pressure on the fiscal balances of the OPEC countries, forcing these countries to reduce the output to increase the price. And number two, if the prices rises above $80 a barrel, tight oil production will grow by 1.5 million BPDs to over 5 MN BPDs.
Is the shortcut for recovery likely to be unfair?
That's another interesting question. The most likely shortcut to a sustained recovery is what we call an unfair mix of orderly debt restructuring and mild inflation. In other words, a transfer from creditors to debitors, debt restructuring, and from savers to borrowers, inflation, is the only way that we see that this could be clean up the balance sheets while maintaining the integrity of the global financial system. So How long will they normalize the monetary policy? Well, the upcoming cycle is likely to be well below historical norms, and monetary policy normalization will probably take longer than expected. The pace of rate increases, how, and the long term, neutral policy rates are much more important for investors than the actual date, the when, of the first tightening move. Clearly, both are likely to be very measured, much lower than in past cycles. The European Central Bank and the Bank of Japan are unlikely to normalize interest rates anytime soon. In terms of the Fed, once the Fed tightening cycle starts, the interest rate differential between the US and the key EMs will strengthen the US dollar and further weaken EM currencies. This is going to reduce the US value or EM's domestic assets and possibly will cause breach in loan convenience. So we need to be prepared because the market should take notice. Investors' reaction depends on expectations, and a long period of low interest rates is not priced in at this time. In the long run, long-term equities will suffer, bond yields rise, and commodities will most likely fall.
The global economy is weak while the markets are strong. Is the financial system reaching an unstable equilibrium? And would you say this will end in tears?
It's funny that you say that because people are crying anytime they listen to the economy or politics today. So I think the disconnection between stock and bond markets and fundamentals is due to abundant macro liquidity and repeated central bank intervention. After years of complacency, data signal risks ahead across the world. Growth is slowing. Leading indicators point to a mild global recession, I would think even more so, that are going to be driven by the EM slowdown. Volatility and financial stress are going up, and macro liquidity is not translating into consistent market liquidity. So what we're looking is policy interventions that are being unlikely to be effective. In this context, central banks risk making policy mistakes and eventually losing credibility with the people. The recent episode of market volatility was an early warning when the central banks start tightening. A bear market correction will take place and the asset prices will most likely decline to match the fundamentals. What does this mean? Capital preservation via a defensive asset allocation is the priority. Yet, unusual portfolios that are less liquid and more volatile are likely to perform better than conventional ones. There's another way of looking at this. So are investment returns likely to be lower than in recent years or not? Not necessarily, because the trade-off between sustained growth and financial stability is likely to continue. Buoying volatility, which means that on paper, financial markets should favor with the orderly functioning of transnational financial flows, sustainable growth, and financial stability. So over the past few years, however, economic growth could only be achieved via the buildup of debt and asset bubbles. So we hear about the tech bubbles, the real estate bubble. This is likely to continue in bond markets. And the regulators in bond markets are going to try and force institutional investors to invest in AAA assets while the supply of these assets have already declined by 50%. We can see this in the quarterly reports of the third quarter of this year, where the yields on sovereign and corporate bonds which pay a spread over government debt have gone down in tandem. So ultimately, the quest for financial safety has brought about severe safe asset shortages and eventually deficits in aggregate demand. Conversely, if the equity markets historically low real interest rates have pushed these asset prices high and created asset bubbles, which is what we're looking at, that will eventually boost investor returns via capital gains.